Welcome to Japan Market Brief, the daily English audio update on what moved Japan's markets and what matters next. April 7th was a useful example of why headline index strength can be misleading. Japan's Nikkei 225 rose 0.75% to 53,519.55. That sounds calm enough. But the domestic demand picture was weak, and the market still had to deal with elevated oil prices and long-term rates above 2.4%. So the better read is this: Japan's market stayed stable, but the macro foundation underneath it still looked fragile. The most important domestic data point was household spending. NHK reported that real household spending in February fell 1.8% from a year earlier. That is important because it argues against a strong, broad-based consumer recovery. At the same time, the market had to process long-term yields above 2.4%, levels not seen since the late 1990s. That means financing conditions remain tight, even when the equity index is holding up. Oil prices were also still high, with WTI briefly in the $114 range. So today's market was balancing three difficult factors at once: weaker demand, higher funding costs, and continued energy pressure. Dollar yen stayed near 159.8, so the currency was not offering meaningful relief. This matters because a weak yen, high oil, and soft demand is one of the more uncomfortable combinations for Japan. There was no dramatic fresh Bank of Japan headline that reset the narrative. Instead, the market kept trading the same basic problem: domestic demand is soft, but inflation-linked and import-linked cost pressures are still alive. Today's stock to watch is Pan Pacific International Holdings, the Don Quijote operator. NHK reported that the company will acquire Olympic Group. That story stands out because it gives the market a fresh retail consolidation angle on a day when household spending data looked weak. In a softer consumer environment, scale and discount execution become more important. Retailers with stronger operating leverage, broader merchandise strategy, and room to consolidate weaker players can become more attractive than businesses that simply rely on consumer confidence improving by itself. That is why this deal matters beyond ordinary and interest. It suggests that parts of Japan's retail sector may be preparing for a consumer environment where value positioning and size matter more. The next step is to see whether Japan's market keeps separating index resilience from weaker consumer data. Watch three things. First, whether more demand data confirms that households are still under pressure. Second, whether long-term yields remain above 2.4%. Third, whether more consumer-facing companies respond through consolidation, price changes, or stronger discount positioning. If those trends continue, the Japanese market may keep moving higher in selected areas, while the broader domestic backdrop remains much less convincing. That is all for today's Japan Market Brief. Thanks for listening.